Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Michael Becker, but he is on assignment, as they say. So joining me today, of course, is James Eng with Old Capital. Hey, James.
Hey, Paul. Thanks for having me.
No problem. So this is going to be fun today. So I think you're really going to enjoy our conversation, the podcast. As you know, Old Capital, we've closed over $400 million in loans in 2016, and that probably translates to over about $500 million in sales. So on the Old Capital podcast, we speak with the folks that are buying and operating multifamily properties. So we are the quarterbacks of the deal. In fact, James, I would say, would be the Tom Brady of lending in the multifamily space for financing. Today in the podcast, we have two brothers, Tom and Tim Black. So both are principals with Napali Capital. Now, this is the interesting part of the deal because Tom is an ER doctor. And Tim, his background has been with large destination resorts. So think of the largest destination resorts in the country. He was the guy who put the operations together. So we're going to talk to them a little bit about how they got into multifamily and what their pursuit is. And then we'll talk a little bit about the book that Tom wrote that really demonstrates his passion for the multifamily industry. So guys, welcome to the podcast, Tom.
Thank you very much, Paul.
And then Tim, thanks for coming in.
Thank you guys for hosting us. We certainly appreciate it.
No problem. I'm going to turn it over to James and let's get going.
All right, guys. Thanks for coming in. So really, maybe just take us back, when you first started looking into multifamily. What were your current professions or profession during the time? And then why did you start looking at multifamily?
Gotcha, James. Thanks. Really, we got to go back a little farther to probably around 2009 or so. I had just completed my residency training in emergency medicine and had moved to the East Texas area from Indianapolis. At that time, as you know, the housing crisis was kind of in full bloom and had read a couple of books and really how this all was birthed was really about tax incentives and physicians and a lot of professionals really, unless you're a business owner, didn't really have an avenue other than, a stethoscope or some pair of scrubs or something to limit some of my taxes. Not that I don't enjoy paying my share of taxes, but had started reading a lot about real estate and bought a couple of single family homes and foreclosures. And then started thinking, all this time that we had been spending, why not try and leverage that into a little bit more? So started getting more aggressive and decided to start trying to develop a few properties. So that's just a brief little background of how I originally got started.
Well, and of course, my path is much different. I'm not an ER physician. I grew up in the theme park entertainment business with Six Flags for about 18 years, and then ultimately moved over to be the chief operating officer at Great Wolf Resorts for the last 12. Tom, being the much taller, worse-looking brother of me, had been banging on me for the last several years to really start thinking about real estate investment because as a W-2 employee, I was paying a ton of taxes and working a lot and didn't necessarily give it a lot of time or thought just because my career was pretty hectic. And I'd say about just over a year ago, I started giving it some serious thought, and Tom inundated me with a lot of material to read and become educated. And that's one of the things that Napali Capital is founded on, is to educate our investors. And so I've been educating myself a lot the last 18 months, and I credit Tom for much of that. It's an exciting space, unlike anything I've done in my career before.
Yeah, and let's not negate the fact that probably 6 years ago when I did buy that land, he thought I was an absolute idiot. And I knew it was all over his face. Here I was in my jacked up red truck with my cowboy boots on, trying to fit into the East Texas culture. And I remember taking him out to the land that I'd bought, that we were going to do this development
I think
out here.
said you need your head examined.
I think you're absolutely right. So I think we've come full circle. That's good.
We have.
Yeah.
So Tom, maybe let's take it from the perspective, there's a lot of high income professionals that listen to this podcast. So let's start from why, especially doctors, should start looking at real estate and sort of your philosophy and sort of how you got into real estate. Tell us a little bit about
Sure.
why doctors especially should start looking at real estate.
It's interesting because I think it's actually twofold. Not only from the yield and the upside of real estate with the tax advantages. One of the big plagues, and I wouldn't say plague is not the right word, say epidemic with physicians right now is just a high rate of burnout. Even over the last 3 to 4 years, if you read the most recent article out of the AMA that was out last month that I actually wrote a blog on, that the average burnout is 50% of all physicians across the board. Now that varies by specialty, but if you take a specialty like emergency medicine or critical care, we're approaching 6 in 10. Actually, 59% of physicians are actually burnt out. And why is that? I mean, we're working an excessive amount of hours. There's a lot of litigious, I'd say, areas that go along with that, depending on the part of the practice or the part of the country you practice in. You have a lot of government intervention. You have a lot of patient satisfaction issues that are getting more stringent. And then you have declining reimbursements. So it creates this perfect storm that people that get into medicine, albeit it's a very altruistic profession, but sometimes when you go to that end of that 12 years of accomplishment, maybe things aren't the way you thought it would be. And I think most of society thinks most physicians are very rich individuals, where I think if you take a cross section of those, I don't necessarily, we do very, very well, but I wouldn't label us as wealthy individuals by any standpoint.
So what do you see as a major challenge for physicians or doctors to get into real estate? Where do you think the challenge is?
Right. I think the biggest thing is just education. And that's why it's so, for me, it's a huge passion that it doesn't take that much education to look beyond the wealth advisor or the financial individual that you're paying to place you in different funds and taking a percentage of that to educate yourself just about the ability to depreciate some property, and maybe other folks that are out there as sponsors or syndicators is a big deal.
So James, Tom's passion is evident. He just completed a book. In fact, just gave me a copy of his book. I've read the manuscript. I thought it was a great job. It really focuses in on, the name of the book is A Passive Income Physician, The Passive Income Physician. I think it has some overtones of Rich Dad, Poor Dad in it. It kind of tells a story about, a happy physician that has used real estate as an advantage, not only the tax implications, but the wealth generation of it, versus the person that only listened to a financial consultant to put him in the stock market and not able to write things off. And it was, put $50,000 a year away, and maybe sometimes you'll be a millionaire. But it's a great book. You'll have to tell us at the end how to get that book.
Sure.
I think it was well written and something that physicians should read, whether it's a physician or an accountant or just an engineer, to take a look at it, just to give you a perspective on what people are looking for. Sorry about that, James. Go ahead.
No, and then also, was there any, obviously, like, physicians hang out with other physicians.
Right.
Was there any advice that you had heard from other physicians, maybe, that they just learn from each other, and so it's difficult sometimes to break outside that mold? Any advice
definitely
that you heard that
it definitely is probably the worst advice you'll hear, actually. Physicians as a whole don't tend to be the most financial savvy folks out there, and really who can be when you're spending an inordinate amount of time learning your craft and then staying attuned with the specialty and all these issues you've got to keep up with CME. So it's no wonder, but usually that education and that advice has been birthed from years of all of us thinking that, to save your money, to put it in your 401k, that mentality is still very predominant in that environment too. And when all of us get together at the bar and the special physician speakies these that we all do, that's not what we talk about. So, yeah. I will say, Paul, we were talking about, with some overtones of Kiyosaki and Rich Dad, Poor Dad. Absolutely. That book is profound. The concepts in there hold true, whether you're talking about Think and Grow Rich or The Richest Man in Babylon. I think all the books have that same overtone. It's just a matter of how you present it and which direction you look at it. And certainly physicians and high-income professionals can do very well by reading any one of those books.
All right, thanks. So Tim, let's turn it over to you for a little bit and just talk about, how did you go from looking at real estate and saying you're crazy to now being in the deal?
Yeah, great question, James. That day I did think he was absolutely nuts. And it's probably been equally as profound for me as it is for him, because I think, one thing that I've learned from Tom is that he runs towards fear where most people run away from it. And that's something that I've tried to keep close to my heart. when I ventured into this space, because it is very new for me. So, when I think about multifamily, what gets me excited about it is, coming off of a pretty long career. I mean, I did a lot of development at Great Wolf. We opened a lot of properties. And there are some similarities when you think about development in rooms and locations. But what gets me particularly excited about what we're doing, number one, is that we're going to build a brand, which I'm particularly excited about. We built the Great Wolf brand, and we think that Napali Capital can be a brand as well, just a brand that happens to be in private equity and investing in multifamily. I am more the Wizard of Oz. I'm behind the curtain, and Tom is Dorothy. He's out in front.
Oh, man, I make
he makes a great Dorothy. So, I really enjoy systems and structure. We're excited to think about CRM to make processes easier for our investors. And the other piece that kind of excites me about this space a lot is, predictive analysis when it comes to pricing. When you think about airlines and hotel operators, pricing is, they spend so much time on it, and they have huge teams of people that are looking at the science and the data. Our inventory, whether it's, airline seats or hotel rooms or apartments, it's perishable inventory. It dies tomorrow if it's not filled. So to think about predictive analysis and how the consumer is thinking about it and what the psychographics are behind that is something that's very intriguing to me. And I think the space is immature in some ways. I know that there's been a fair amount of it done in the bigger DMAs, Dallas, New York, Seattle. If you walk into an apartment complex today, downtown Dallas, it's going to be one price. If you come back on Saturday, it's likely going to be a different, because they know who you are and what your habits are when you're walking in, what time of day, what time of year, et cetera. So I think there's some of that math and science that can be applied. Certainly not everything, because the inventory is much smaller, but I'm uniquely excited about that, to think, when we work with our management companies moving forward and we start to grow our portfolio, to think differently about pricing.
All right, great. Let's go through, maybe kick it off with your first deal and sort of your subsequent deals and sort of get into those. So maybe kick it off with the first deal. I mean,
all right, okay.
It was a little different.
It all started with that land in Longview. So when I left residency in Indiana, I was finding myself working a ton in the emergency room, missing my family. And it was being an ER doctor in a very large level 2 trauma center. You tend to try and distract yourself. And I was really interested in real estate. So found a piece of foreclosed land in Longview. I had a partner that was a custom home builder, and we went for it. I went and signed on the note at the bank, really not knowing what somebody should know on developing a piece of property. It took us about 18 months to go from start to finish, from clearing the land from utilities and all these things that I probably should have been
How many units?
Only 16.
16.
At the time, it felt like 120, though, I promise you. It was the hardest 16 units ever to build, and there always was problems. And I had no idea.
Mom and Dad were the management company, too.
Yes. Okay.
We'll get to that.
No, I wasn't planning on getting to that, but thank you.
Sorry, Tom.
I switched it soon after. Thanks. Yeah, so we ground up, learned a lot about management, a lot of code, which I didn't realize, a lot about general city managers, planning, the whole 9 yards. So luckily we're successful in that deal. Had it about a year, stabilized it, and ended up selling it right at the top of the market. Started to realize that Longview was getting a little overbuilt. This was before oil started to decline. There was a couple of large apartment complexes that came in that were A-class, and you could see the writing on the wall that my little 16 units, although they were very, very nice and with granite and stainless steel appliances, and that's another lesson learned, that don't build something that you would like to live in. Right. Build something cost effective would be one of my best advices. So yeah, so we're successful and sold it.
Would you do it again? I mean, in your book?
Absolutely, I would. I would. It took years. I mean, I've got gray now after doing that. I would, but I would do it now just based on what I know now, the knowledge. I didn't realize what I didn't know, and that's probably the biggest thing.
Yeah, I think Tom was going to liquidators. Himself picking out flooring.
That was one of the big mistakes.
Stuff in his truck.
Use your vendors appropriately.
Right,
when you get into that size of things, going to pick out individual. It's economies of scale.
So after that development deal, you said, maybe I should start looking at cash flowing.
Yeah, I think
deals.
cash flowing entities.
What was maybe the second deal that you got into? And
so we took that money actually, and then we parlayed that into some light commercial that was around in that East Texas area. We ended up doing some one-off developments, a couple leasehold improvements for some oil field lease companies that we do very well on. We developed 2 more out there. and have had signed lease contracts and for 10 years. So they've been absolutely fantastic. In addition, we bought a couple of more out there just because they were doing so well. So from there, that's when the writing was really on the wall with me as far as the practice and where my love started to go and what I really enjoyed doing, and made a really hard decision one day to up and leave the practice. So we packed up the family truckster and took off to Dallas just because we knew the opportunities were going to be much, much larger. And it's been great. It's been the best decision, hardest, but the best decision of my life.
So when you moved to Dallas, what was the first multifamily property that you guys got into?
So first multifamily, we ended up finding a property after much looking named Rio on the Parkway, which was just down in the southern corner of Arlington. And this was probably a year and a half ago, I guess. One of our first big acquisitions anyways. It was 305 units that we've since rehabbed, renamed, and we're doing fantastic out there. So that'd be the second. And it's been, oddly enough, it was much, much easier than doing a development. Much easier and much more profitable.
So
investors.
I guess maybe go through some of the high level on that deal. Maybe tell us about sort of how you guys are managing it.
Sure.
What you had to do during the acquisition, and now to stabilize the property.
Sure. So one of the big items was the rents were already under for the comps in the area, probably $50, $75 a unit. So we had a lot of upside there, but one of the big things is all the properties around in that area had implemented RUBS and or were doing all bills paid. So, and they were largely above, the all bills paid property is probably about $150 a door, something like that. So we went in, we instituted that. We did a lot of individual upgrades on the amenities. We actually put in a soccer field for them because that demographic, it worked out very, very well. And then really just refaced the property, and it's been doing amazing. We partnered with Citygate on that property, and they've been exceeding our expectations.
Okay.
So I think we're in year 3 of that pro forma.
Oh, wow.
Yeah.
So it's been a great
It's been.
run. And then you guys are about to close on another property next week.
Right. We've got Monterey down in Southwest Fort Worth off near Ridgely Hills that we're going to be closing on.
Thank you, Paul.
Yeah. Thank you very much, Paul.
No
Paul's
problem.
helping.
So it sounds like you've sort of moved into multifamily, and really that's going to be your focus.
Yeah, I think that we do have some. We've still got some connections with some light industrial properties that we're going to be going after, but it's definitely a different space, and the loans are, as you know, are completely different. I mean, these are recourse loans, and so there's a lot of different up and downsides that we've got to factor in when you're considering a non-recourse versus a recourse loan.
So tell me what you like about multifamily.
It's stable. I never have to worry about my tenant or the oil field going bad. Multifamily is great, especially the B and C space. I think that the economy, even if we see some changes, I think people always need a place to live. The underwriting is certainly very favorable right now with interest rates. It's compared to all other avenues right now, I think it is the most safe real estate space to be in.
Is it easier to raise capital for multifamily transactions compared to maybe that development deal or even
the
industrial
funny
deals?
thing, the development deal was done on my back. So I remember thinking back in 2010 that $1 million was just a heck of a lot of money, thinking there's no way I can do this. I started with about $3,000. Now, I mean, it's just a matter of, it's a state of mind, right? I think with doctors, it really depends. I think it's about an educational standpoint and educating them about what an accredited investor is versus a sophisticated. Most of them have no idea what that truly means, and the ability for them to have the accredited stamp and to leverage their high income, which will translate to a high net worth. And so that's really what the book is about. The book is about surviving your, maybe an intense career or a crisis in a career by increasing your net worth. So you don't have to do that. I mean, I think retirement is such an antiquated term now. I mean, especially physicians, we go to school for so unbelievably long. Why do we want to bail after 10 years, 15 years? And that's kind of the sentiment that's out there right now. They're just exhausted. If you could change that and have passive income and work a little bit more on your own terms and maybe not work 80 hours a week, maybe 20, 30 hours a week.
Well, and they're also seeing real money in form of checks coming every quarter.
Right.
Which,
Absolutely.
not
Real money
many
is
people get
different
to see that, right?
It's different than money
Especially
going
with
into
your
your IRA,
investments. And
right.
you get a statement at the end of the year, and if you're lucky, it was +1 or +2%, right? So,
yeah. There's nothing like seeing some depreciation on that
Right.
K1 at the end of
That's
the year
right.
too, knowing that your tax is going
Right.
to be reduced. So
When you talk to physicians or investors in your deal, what are they looking for in your transactions? Like, what are they looking for? A specific return, cash on cash? What are they looking for in terms of the
I
deal?
think it depends on the way the deal's presented. I think up front, when you're talking cash on cash, I think most folks from 8 to 10% is probably very realistic. I mean, you're not going to find that anywhere in the market right now unless you're really lucky. You may find it, but then you're going to get your fees and everything else from various houses that are going to reduce that. I think the deal changes depending on what the reversion is. I mean, if you're talking after the sale of a property that you're doubling their income in 3 to 5 years. That's very, extremely palatable for them, and they love that. If we're talking a real estate deal where we're doing a recourse loan and maybe Nepali is taking the recourse side of that, where there's a lot more risk for us, we've looked at 10, 12, 15% pref, and they seem to be pretty happy with that too. But by and large, with the multifamily space, we've been looking at 8, 10% guaranteed, and then some sort of 100% after 3 to 5 years. So you're getting all your money back plus 100%, which isn't a bad deal.
Right. Most people are very, very excited.
Right.
So, as deal sponsors now, what do you guys spend? If there's one or two things that you spend your most time on, what would it be?
Oh, wow. So for me, I think we operate very well together, and therefore we have 3 completely different avenues that we go on. For me, it's definitely education. I'm taking calls from physicians, dentists, chiropractors, vets, all kinds of folks.
Cat doctors.
Yes, cat doctors. I did have a sloth doctor the other day. Called me. He was slower on the phone than most. So, it's a lot about education and just trying to teach them what accreditation is and giving them the opportunity. And for me, there's a lot of them out there that may be married to a physician or have ties to them, and they know that they're trying to get their wife out of a situation or she's unhappy at work, and they're willing to do that too. So we actually have a couple of guys that go and look at properties just to learn. They just want to learn the process. They might have been home flippers or wholesalers, just different walks of life, and it's been fascinating. But I definitely spend a lot of time taking calls, just education. Okay. But it's fun.
Yeah, and I would say for me, probably what I'm spending the most of the time on right now is working with Abel. A little shout out to Abel Singh, who's our vice president of finance, wicked smart guy, came out of private equity, so he speaks the private equity world, which we love. He and I spend a lot of time together putting the numbers together, looking at the numbers. But probably for me, where I spend most of the time is just trying to create structure and streamline processes. We're really, really nimble. It's pretty common for us to be texting each other at 10 o'clock at night at 6 a.m. in the morning, and hundreds of texts throughout the day. And that's one thing we love, is that we're very nimble and quick to make decisions, the proper decisions, and putting processes in place. So that's what I spend probably, most of my time on now, is just structure and processes and making it easier for our investors and being able to communicate to them effectively the way most people want to be communicated.
Yeah, and that's a big piece of who we are, to get out to use CRM to inform them. And we've sent out several notices even on Monterey that, hey, this is where we're at in the process. We've already raised our capital, but here's where we're at.
People
the worst
love
thing you
updates,
can do. Yeah, they want to be updated about their money.
Especially when they give you their money.
They absolutely want to. You need to be available.
50,000 or 100. People really want to know what's going on. And it's really good to give them a look underneath the hood. We're very, very transparent. And that's one thing that, both Tom, Abel, and I, all 3 of us believe in, is that, if you want to see the deal structure, if you want to see anything, we want you to look at it.
Yeah,
because
we're not
again,
afraid to
the
take a
more
call
educated our investors are, the better investors that they are. So
obviously you guys are brothers. How do you guys manage that dynamic in terms of family, business, wives being, are they supportive? What are your spouses' roles in the deal?
I never even thought about
Are they... How do you guys handle that?
So let me just start off on that one. So I retired in March from Great Wolf, and after about 30 days of being home, my wife was ready to kill me. For my whole career, I've been on airplanes flying coast to coast and not around as much as maybe I was. And so she said, dude, you got to go out and find something to do. So
yeah, and you're only 51.
I'm young. So, I was mulching the garden beds and oiling the locks at home and things like that. She's like, all right, it's time to do something. So at least on my end, my wife and I own some real estate together, some multifamily in Madison, smaller properties. We only have 22 doors, but she spends a lot of her time on that. I don't spend a whole lot of time with it. We bought them, we jumped in, and
she sends gift baskets, things like that to the tenants.
Yeah, right. She wants to do all the flowers when people, check in, except not checking in, but when they show up. But anyway, we won't digress. So, I think that the dynamic has been really good. It certainly brought Tom and I closer together when he had a full-time career, and his kids are about 10 years younger than mine. So we're at different stages of our life. But it's definitely brought us closer together, and I think our family's closer together, which is really,
absolutely.
Really cool.
I'd say it has. Yep. But no, I haven't noticed any friction yet, James. But thanks for bringing that up.
it's
one those new bamboo sheets you have.
They are nice though.
So it sounds like you've been in the business for a little bit now. In terms of multifamily, been in it 4 or 5 years. Anything that you've seen maybe in the last year in regards to multifamily that maybe you've changed your mind about or thought about, and maybe an experience has...
It's tight. It is very competitive out there. And I think the one thing that we have to remember and we seek, in addition to communication, is making darn sure that those numbers work and having very, very conservative underwriting. Just going after a deal because you like it or because the numbers look great right now doesn't portend the future. And I think that's one of the hardest things that you have to face. Just because it looks good now doesn't necessarily mean it's a good deal. And we have to be very, very cognizant of our investors. And that's who comes first in the end of the day is our investors.
Is there anything that you've changed in sort of your underwriting or to sort of accommodate that? Or
no, I think that other than just, I think my preference is for longer periods for the loan and being more conservative on that. I like to look at things that are probably at least a 10-year note because I don't know where, I don't have a crystal ball and nobody does. But that's where my comfort zone is. If it was a long view project and it was $1 million and it was 5-6 years ago, it's a different situation. But bridge notes and things like that aren't up our alley right now, just because I think you find a niche. Right. And you do what you know and what you're comfortable with. And that's where our investors are too.
And I think the other thing that we've gotten aggressive with recently is just putting more hard money down. And that seems to have separated us from some of the other groups, that we're willing to put money down on day one because we believe in the project. And we've looked at the numbers enough to believe it's the right thing to do for us.
Yeah. So how did you guys get comfortable putting money day one? Are you doing inspections before, trying to get access to the property, anything
no,
on the front end, or are you just...
No, if there's existing debt on it, depending on what that debt structure is, if it's a Fannie loan, I don't have a problem putting multiple 6-digit numbers down. That has passed underwriting before. That's right. Now, if there's a bank loan on it and maybe the property has a different situation, but I think it's a one-off situation, decide where and when that's appropriate. But for the most part, at the units we're looking at, it seems to be the case. But no, we haven't currently asked for any, early access agreements, things like that. Because I think it is a tight market. If you find that one property that does work and it's going to be good for the investors, then you got to.
I think the beauty also is that the management company that we're working with right now in Monterey knows many, many, many of these apartments and deals. So they tend to have looked under the hood at some point and know a lot about the properties much before we do. So there's a lot of intel that we get very, very early on.
And you've got Paul.
Right. And
Paul. You've got Paul.
That's right. Your magic ticket.
That's all it is. If it's not sealed and Paul approved, then you have to look otherwise. It's stamped.
That's good.
Yeah.
We definitely like that management company that you guys work with. And I think that you guys are very unique. Tom being an ER doc and Tim being an operations person for some of the largest entertainment companies in the United States is the operating officer. So it's gone from managing thousands of people to managing tens of people.
Yeah, tens of.
Paul, I will tell you that I'm doing things now that I don't think I've ever done before, but I'm learning quickly.
we have gotten an executive assistant recently, and he's like, "Thank God!" And she's been awesome.
She's been great.
So there's tremendous synergies. Being brothers, kind of understand a little bit about your backgrounds. This was a little bit of a struggle for you, and as I read through your book, Tom, which I thought was just fantastic. In fact, let's put a shout out on that. Tell us, how can people get your book?
Gotcha. It actually went live today on Amazon and Kindle also. So if you just go to Amazon and type in Thomas Black MD, you'll pull up my author page. Otherwise, you can also do the title of the book, which is The Passive Income Physician. Subtitle is Surviving a Career Crisis by Increasing Net Worth. Pretty easy to pull up. There's not much competition with Thomas Black MDs out there. So
no, we're going to follow that up with a national press release next week.
Right, we do have a press release coming out also.
So you guys have your natural background of knowing other ER physicians. Do you think that also applies to accounting and engineering and other groups that say individuals want to get into multifamily,
right,
that may not have other ER doctors?
Oh, no, absolutely. And that was one of the struggles about the title of the book, that I couldn't figure out if I wanted to make it more general and say the passive income professional. But I thought, just because this is the most near and dear to my heart, because I've lived it and I've been in that situation, dying to get out of a situation that I didn't think that I was going to get through. So,
you guys as ER docs, as you explained, you guys do make good money. I've seen your personal financial statement. I've seen what it was, say, 3 years ago, and with the ownership of all these units. And you're being bashful because you own a couple 1,000 plus units on properties.
Yeah. I've done in the last 2.5 years. It has been tremendous, and I think that's where Tim really, if he's going to lie, he probably saw my financial statement and goes, "Holy crap! I think I'm barking up the wrong tree here. Maybe I need to look into real estate."
So that net worth is a huge thing. You can have income, but that expansion of the net worth, and I think that's one of the biggest things that really comes across in this book, is that you could have large dollars coming every month or every year, but if you don't have an expansion of your net worth, I mean, you're really not
right. You're still punching the ticket. You're still
exactly
punching the clock.
You don't have a lot of options of what you can do in the future.
Right.
And I can see, with these, like I think explain in your book, you were working, just going through school, 100 hours
easily
a week.
Yeah, easily. Yeah.
And now, being in the multifamily business and spending time with your family, and that's down to a lot less. What kind of an impact has having ownership in multifamily done for you?
It has changed my family tremendously. This, when one of the pivotal points that I decided to leave the group I was with is the kids. I showed up to a baseball practice, and they all looked at me and asked me why I was there. Thinking, well, wait a minute, I'm your dad, remember me? They just, expected me to be at the hospital, working as much as I did. And that was one of the impetus for me to say, I'm doing the wrong thing for me and my family. And ultimately that's where my heart is. And real estate's allowed me to get there. I just took a call actually yesterday from a gentleman that found me through a channel that I've never met before that's an ER doc. And we had a long talk together, and that was his issue too. It's about freedom. He loves being an ER doc, but he knows that he's going in and he's punching a clock. Some docs may not be like that. You may be an orthopedic surgeon or cardiothoracic surgeon or a pediatrician. Their pay structure may be different, but at the end of the day, we don't typically own our own business. It's usually contract managed. A lot of times the trend is going towards a W-2 status with a large entity.
And that's what I understood from your book, especially with the ER piece, is that you guys have left the hospitals to go to some of these doc in the boxes and really become a W-2'd employee.
Right. And that's been a big trend in Texas too. Yeah.
And the government really determines what your paycheck is these days.
Absolutely. For various channels it is. And that's great, but it doesn't allow you to leverage other people's time, other people's experience, and really to leverage that high income that you're making to be able to do other things in life.
You're just a vendor for the hospital.
Exactly. That's all you are. You're a contractor
employee
to
the hospital.
Right.
Here you really can own your own business.
Essentially it is, yeah.
Take the depreciation, take the write-offs against the business itself, expand your net worth, have somebody else manage the assets for you. And then what he's so good at is he's out there with Tim, with Alex, and just going out there and finding brand new deals and taking them under contract and having Tim go and make sure they operationally work. So I kind of like the structure that you guys have kind of, I wouldn't say forced together, but I like the brains in the front side, the beauty in the front side. The guy
That's right. You did say beauty, right?
The guy who's the hardest worker is really Tim. Making this whole thing work.
Let's hear for Paul. Round of applause.
Sliding that 5 right on the table.
One thing I do want to go back on that you mentioned, does the book apply to accountants and engineers? It absolutely does. And, me coming out of my background, now I'm tasked to start to find investors that I've had relationships with over the years that are all professionals. Yeah. And it does absolutely translate. You don't need to be a physician to read the book.
Not at
all.
In
fact,
not
that's
at all.
really not what it's about, right? It's about, thinking about money and real estate a little bit differently. He just happens to be
I just use it as an analogy
That's
just because of where I was.
That's right.
But the rules still fit, absolutely.
Yeah, and it tells a good story about Tom kind of finding his way at the beginning and then actually seeing what hard work does to people and turning the ship around, so to speak, because you were in the Navy a little bit.
I was in the Navy, yes, and that's at age 17.
Tom doesn't want me to weigh in here on
these
Navy stories and the calls I used to get.
But then you went to school, you went to medical school, did residency at Indiana University, and then you became an ER doc. So there's a great story. I like it. I recommend people understand it and kind of talk a little bit through it.
Yeah, and then in terms of, it really helps. And I think what's going to make the impact on the book and what made an impact on me is really because, Rich Dad, Poor Dad, he really told his story. Mm-hmm. And so I think that's why you chose the title. That's why you chose the book and wrote the book, is really to share your story.
Exactly.
And so I think people will have a much greater understanding of sort of the work that you've put in and how you got to where you are now. So
I hope so. Certainly, it took a year to write, but it was absolutely very fulfilling. I was shocked. The more I wrote, it just kind of came out, and that was what was neat about it being my story, and it was particular. So,
So what is the best way, if people have any more questions maybe about the book or about what you guys are doing in multifamily, what's the best way for people to reach out to you?
Sure. So a couple of different ways. We've got our website actually with Napali Capital is Napali Cap, and that's spelled NAPA.
LICAP.com.
There you go. You want to repeat that one more time?
Napalicap, NAPALICAP.com.
Very good. Look at that. Yeah. And then also I do a blog, which is entitled Freedom in the Black, altogether.com. Correct. So there's multiple ways. I have links on there to the book, and we have some communication both back and forth from the blog to the website too. So
and email addresses, it's tim@napalicap.com or thomas@napalicap.com. Yep. Very easy to get a hold of us. And you can always call Paul.
You can always call Paul, yeah.
Paul knows. He knows where to find us.
And now you guys are out looking for new stuff. So congratulations on closing Monterey. Another good transaction. We appreciate it.
It's been great.
It has been really very smooth. Very smooth.
Yeah, the Doherty people have been fantastic to work with.
I love it.
Yeah, they have been. Shout out to Fritz.
He's a good man.
He is.
So talk a little bit about James, about what's coming up these days.
Sure. The next event, the next speaker series we'll have is on Wednesday, April 26th with Mark Dotzauer of the Texas A&M Real Estate Center. That'll be at the Grapevine Convention Center starting about 6 o'clock.
You definitely want to go there. Dotzauer does a wonderful job of explaining exactly what's going on in commercial real estate, not only in the state of Texas, but also throughout the nation. And he is well worth the time to come see him at the Grapevine Convention Center. Also, too, is that if you have a chance on the Old Capital podcast, if you have any questions concerning how these deals get financed, we have a 15-page white paper report called Multifamily Financing 101. Make sure you ask for that. Second report that we want to do that's from Michael Becker. It's really kind of a due diligence checklist about when you do get an accepted LOI and you are under contract and you want to start looking at the property. Kind of a checklist of what to look for on the property, things, physical due diligence, what you should be looking for. It's a couple-page report. I think it's fantastic. Make sure you go to the oldcapitalpodcast.com website, take a look at that. And the last thing is that if you found this podcast to be valuable, please go back into ratings, and we'd love to have a 5-star rating on iTunes. We would appreciate that. James, anything more to add?
That's it. Thanks, guys, for coming in.
No, thank you,
Thank you
gentlemen.
guys
Really
very much for
appreciate it.
hosting us.
All right, Dr. Tom Black, Mr. Tim Black.
Oh, zing!
Somehow doctor sounds a little better.
That's right.
Didn't go to evil medical school.
Yes, that's right.
That's right. Guys, thanks for coming in.
Thank you.
We appreciate your time. I'm
Take
Paul
care.
Peebles. Thanks.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.